Given that we believe the earnings recession is far from over, we believe March to be a high-risk month for the next leg lower in stocks, according to strategists led by Michael Wilson, who was ranked #1 in Institutional Investors Survey last year after correctly calling the stock market sell-off.
We thought there could be a pivot on February 1st, but then of course the data came in a bit stronger, and the Fed doesn't want to give any chance to inflation rearing its head again. So we think there's at least 2 more hikes, maybe 3, going into June, and that got priced into the bond market over the last 30 days, but stocks seem to have ignored it, and so what we're left with is just stocks are more expensive, and there's really no justification for that because the earnings picture really hasn't improved yet.
Investor optimism has been bolstered by analysts delaying decreases to earnings projections for the upcoming 12 months, according to Wilson. But before the downward trend picks up again, he noted, the outlook tends to level out in bear markets between quarterly earnings seasons. Stocks typically realize it a month in advance and trade lower, and this cycle has precisely exemplified that trend.
What do you think? What is your estimate for the S&P for the year, Mike?
Yeah, so our base case hasn't changed, Joe. It's $195, and we have a bear case. If we have a recession, it's closer to 180, 185.
Okay.
We're still kind of holding out that a recession is avoidable, but the margin degradation is not, and that's really, I think, where we're differentiated. Now, what we have heard from clients more recently is that not just because the economic data has been better, but there's better tone out there that perhaps the earnings degradation doesn't have to be as bad as people were thinking 2 or 3 months ago, and we just disagree with that. That's what our work suggests. I think some of those retailer results this morning kind of prove our thesis again, which is that profitability is the question, right? This is, inflation increases your operating leverage, and that cycle has turned down. We'll get through it. This is not the end of the world. This is not 2008. There's not going to be a financial crisis. This is just a good old-fashioned earnings recession because of the over-earning that we enjoyed during COVID.
The S&P 500 has fallen for 3 weeks in a row due to worries that persistent U.S. inflation may lead to further Federal Reserve rate hikes. That came after a rebound of as much as 17% from the lows of October, propelled by expectations that the U.S. central bank would soon change its hawkish approach. As Wilson noted, the S&P 500 has reclaimed its 200-day moving average. With uncertainty on the fundamentals rarely this high, the technicals may determine the market's next big move, Wilson added. We believe that this rally is a bull trap, but we also understand that if these levels can hold, the equity market may have one more chance to hold up before we completely price the earnings downside.
Where we think the earnings now reflect closer to reality, and valuations reflect that too. It's a two-edged sword. So the Fed will be part of that story, but I think the Fed will probably be cutting rates long after the market has bottomed. That's my general view, because the Fed is going to have to hold firm. I think they're going to do their job. Jay Powell is here to make sure he gets inflation down, and as you said at the beginning, Guy, there's no incentive for him to get off the train too early.
The expert has predicted that the S&P 500 will decline as much as 24% to 3,000 points in the first half of this year, and that equities will bottom out in the spring. He said that valuation is generally pricey, repeating a statement from the previous week.